Welcome to our channel. Today we're diving into an exciting topic, how to turn $100 into $10,000 in the stock market step by step. Let's get started. Alright, let's talk about why starting small is actually a huge advantage. Think of it like this. When you're just starting out, you're learning the ropes. You're experimenting, you're figuring out what works and what doesn't. And that's okay. Because when you start with a smaller amount like $100, even if you make a mistake, and trust me, everyone does, the impact is minimal. It's a learning experience. Now imagine if you had started with $10,000 instead. The stakes are higher, the pressure is on, and any mistake feels way more significant. Starting small allows you to take risks, make those mistakes, and learn from them without breaking the bank. It's all about building that foundation of knowledge and confidence. Plus, think about the percentage gains. Turning $100 into $200 is a 100% return. That's huge! It's much harder to achieve that kind of growth when you're working with larger sums. So embrace the small start. It's not about how much you have, it's about how you use it to learn and grow your investments over time. Look, I get it. Research isn't the most glamorous part of investing. It's way more fun to imagine yourself sipping mojitos on a beach with your massive stock market gains, right? But trust me, the research phase is crucial. You wouldn't buy a house without inspecting it first, would you? The same goes for stocks. You need to understand what you're investing in. Don't just blindly follow the hype train. So, where do you start? Well, thankfully, we live in the age of information. You've got company websites, financial news outlets, analyst reports, it's all at your fingertips. Look at a company's financials, their revenue, their profits. What's their track record like? What are their future plans? Are they innovating? Are they expanding? These are all key questions you need to be asking. Don't be afraid to dig deep. The more you know about a company, the better equipped you'll be to make informed investment decisions. And hey, if you're not sure where to start, there are tons of resources available online. Investopedia, Khan Academy, they're all great places to learn the basics. Alright, let's talk about diversification, your secret weapon against market volatility. Now, you've probably heard the saying, don't put all your eggs in one basket. Well, in the stock market, that's basically the golden rule. Diversification means spreading your investments across different asset classes, sectors, and even geographies. Think of it like this. Instead of betting all your money on one horse race, you're placing smaller bets on multiple horses in different races. That way, even if one horse loses, or in our case one investment underperforms, you're not wiping out your entire portfolio. You've still got other investments that can potentially pick up the slack. So how do you diversify? Well, you can invest in different sectors like technology, healthcare, energy, and real estate. You can also diversify across different company sizes, from large cap stocks to small cap stocks. And don't forget about international diversification. Emerging markets can offer some incredible growth opportunities. The key is to find the right balance that aligns with your risk tolerance and investment goals. Okay, let's talk about the most important ingredient for success in the stock market, patience. Now, I know, in the age of instant gratification, patience can be a tough pill to swallow. We want it all, and we want it now. But the stock market doesn't work like that. Building wealth takes time. It's a marathon, not a sprint. The stock market goes up, it goes down, it goes sideways, it's a roller coaster ride. And if you panic sell every time the market dips, you're going to miss out on those long-term gains. Remember, when you invest in the stock market, you're buying a piece of a company. You're betting on its long-term growth potential. So, don't get discouraged by short-term fluctuations. Tune out the noise, stick to your investment plan, and let time work its magic. Compound interest, the eighth wonder of the world, will take care of the rest. Alright, we've talked about buying, we've talked about holding, but now let's talk about the other side of the coin, selling. Knowing when to sell is just as important as knowing when to buy. Now, this is where it can get tricky because emotions come into play. We get greedy, we get scared, and we make irrational decisions. That's why it's crucial to have a plan in place before you even buy a stock. Ask yourself, what are your profit targets? What are your loss limits? Having these predetermined exit points can help you stay disciplined and avoid making emotional decisions. Another thing to consider is your investment thesis. Why did you buy the stock in the first place? Has the company achieved its goals? Has the story changed? If your investment thesis is no longer valid, it might be time to reevaluate your position. Remember, it's okay to take profits. don't be afraid to sell when you're happy with your gains. There's no shame in locking in profits and moving on to the next opportunity. Thanks for watching. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell for more financial tips and strategies. Remember, investing in the stock market is a journey, not a get-rich-quick scheme. It takes time, patience, and a whole lot of learning. But with the right knowledge and strategies, you can turn your financial dreams into reality. Happy investing!